So you want to know if you can actually afford to own a duplex. Not the fantasy version where you picture a tenant's rent check magically covering your entire mortgage while you build equity for free. The real version, the one where the exact same property can put $500 a month in your pocket in Cleveland and lose you over $1,000 a month in Tampa, depending entirely on the numbers you run before you ever sign anything. Subscribe before we start, because by the end of this, you'll know exactly what a duplex actually costs. From the down payment to the mortgage to the maintenance reserve nobody budgets for correctly, and you'll understand why the sticker price of the property is genuinely one of the smaller variables in whether this turns into real wealth or a monthly bill you didn't expect. Let's start with the number that varies more on a duplex than almost any other real estate purchase: the price itself. In the most affordable markets in the country, places like Detroit and parts of Cleveland, a duplex in a decent neighborhood can be found for under $200,000, and in some cases under $150,000, with secondary market guides putting realistic acquisition prices somewhere between $90,000 and $280,000 across selected affordable markets. In expensive metros, that same property type routinely costs $500,000 or more. And in hot Sunbelt markets like Tampa, a newly built duplex with 2 solid 3-bedroom units can list for $800,000, putting it in an entirely different financial category despite being structurally the same kind of building. And for anyone financing through FHA as an owner-occupant, which is how the overwhelming majority of first-time duplex buyers actually get into this asset class, the 2026 standard FHA loan limit for a duplex sits at $671,200, with higher limits available in expensive coastal markets, meaning the financing ceiling itself effectively defines how far up the price range a typical buyer can realistically shop. Now let's talk about what actually makes a duplex different from every other property type we've covered in this series, because the financing structure here genuinely changes the math in your favor if you play it right. If you plan to live in one unit while renting out the other, a strategy commonly called house hacking, you can qualify for an FHA loan with as little as 3.5% down, dramatically lower than the 20 to 25% down payment a straight investment property loan requires. On a duplex priced at that 2026 FHA floor limit of $693,050, 3.5% down works out to just $24,257, a fraction of what a conventional investment loan on the same asking price would demand. And lenders will typically credit 75% of the projected rental income from the unit you're not living in toward your qualifying income, which can turn a deal that wouldn't otherwise clear underwriting into one that does. Here's where it gets structurally different depending entirely on which market you're buying in, because the exact same financing advantage produces wildly different monthly outcomes depending on the price-to-rent ratio of the property. Take a real example from a newly built duplex listed in Tampa for $800,000, with 2 3-bedroom units renting for a combined $4,500 a month. Running the actual numbers, 20% down, a 30-year fixed mortgage at 7% interest, plus property taxes, insurance, and standard reserves for vacancy and capital expenditures, the mortgage, insurance, and tax payment alone comes to just over $5,000 a month against $4,500 in rental income, meaning the owner is already $631 a month underwater before a single dollar of maintenance or vacancy reserve is factored in. And once those reserves are added, the total monthly loss stretches past $1,300, adding up to a loss of over $9,000 across the first year, even after crediting the equity built up through mortgage paydown. Now compare that to an affordable market duplex in a place like Detroit or Cleveland, where a property priced well under $200,000 can generate combined rents of $2,000 or more, producing positive cash flow from day one, and cap rates reaching the low teens in some Detroit scenarios. A return profile that simply doesn't exist in expensive coastal or Sunbelt metros, no matter how creatively the deal is structured. So what does the income side actually look like when the numbers do work, and what does that translate to for the owner? For a house hacker specifically, the benefit doesn't always show up as pure cash flow. It often shows up as dramatically reduced housing costs instead. since living in one unit while renting the other can reduce your personal housing expense by 50 to 80% compared to renting or owning a comparable single-family home outright, effectively creating what industry guides call implicit cash flow through savings rather than a monthly check. One frequently cited example involves a buyer whose FHA-financed rental income covered roughly 87% of the total mortgage, leaving just a few $100s a month in out-of-pocket housing costs, compared to paying a full mortgage plus taxes and insurance, with no rental offset at all. Once that first property is stabilized after the required occupancy period, typically 12 months under FHA rules, the owner can move out, convert their former unit into a second rental, and use the accumulated equity and cash flow experience to repeat the process with a new property, which is exactly the pattern that industry data shows behind a meaningful share of investors who go on to build multi-property portfolios starting from very little initial capital. Now for the stuff nobody warns you about before you make an offer. First, the 1% rule, the informal industry benchmark suggesting monthly rent should equal at least 1% of the purchase price, is exactly why the Tampa example above fails, and the Cleveland or Detroit example succeeds, and running that single ratio before falling in love with a listing photo can save a buyer from months of negative cash flow they didn't see coming. Second, vacancy is a real and recurring cost that beginning buyers routinely underestimate, with industry guides recommending a 5 to 8% vacancy buffer built directly into cash flow projections from day one, since a single 2-month vacancy on one unit of a duplex, planned for at 100% occupancy, can meaningfully stress an otherwise tight budget. Third, the median monthly owner cost on a financed property climbed to $2,035 in 2024, up nearly 4% in a single year. A reminder that taxes, insurance, and financing costs have been rising steadily, and any analysis built on last year's numbers can already be out of date by the time an offer closes. Fourth, moving out of a house-hacked duplex doesn't automatically preserve the good economics that made the deal work in the first place, since the unit you used to occupy has to rent for at least what the other unit already rents for to maintain the same total income, and a buyer who never stress-tested that number before house hacking can find their eventual full rental cash flow considerably weaker than what the house hacking phase implied. So who's actually winning at this? Overwhelmingly, it's buyers who choose the market first, and the property second, prioritizing price-to-rent ratios in the Midwest and parts of the South over emotionally appealing but financially punishing metros, and who run the 1% rule and a realistic vacancy and maintenance reserve before ever submitting an offer rather than after closing. It's also buyers who deliberately choose duplexes as the entry point into a repeatable strategy, using the FHA owner-occupant advantage once, then converting and repeating with a second and third property, compounding the low down payment advantage across multiple deals rather than treating the first purchase as a one-time transaction. How do people actually lose money on this, or badly underperform the promise of free housing they saw online? Almost nobody loses money because duplexes as an asset class don't work. They lose money because they bought in a market where the numbers were never going to clear the 1% rule in the first place, treating an appealing new construction listing in a hot metro as equivalent to a cash-flowing property simply because it was structured as a duplex, and then discovering, exactly like that real Tampa example, that a beautiful newly built property with strong rental comps can still bleed over $1,000 a month once financing, taxes, insurance, and reserves are honestly accounted for. Okay, so let's put the real numbers side by side. A buyer purchasing that $800,000 Tampa-style duplex with 20% down is looking at a first-year cash loss north of $9,000 even after crediting equity paydown, a deal that only makes sense if the buyer is confident in strong future appreciation to offset the ongoing negative cash flow. Now the disciplined version, a buyer purchasing a duplex in an affordable Midwest market for under $200,000, using FHA financing with 3.5% down, generating combined rents that clear the 1% rule with room to spare, can realistically be looking at positive cash flow from month one, a dramatically lower total cash to close, and a cap rate in the double digits, the exact same asset class producing a completely opposite financial outcome purely because the underlying market and price-to-rent ratio were chosen correctly from the start. So yeah, can you actually afford a duplex? If the question is whether you have 3.5% of the purchase price available for a down payment, that bar is genuinely lower than almost any other real estate investment available to a first-time buyer, which is exactly why duplexes have become the go-to entry point for so many new investors. The real test isn't whether you can qualify for the loan, it's whether you've run the 1% rule, built in a genuine vacancy and maintenance reserve, and chosen a market where the rent-to-price ratio actually supports positive cash flow, rather than simply falling for the first appealing listing photo in a market where the math was never going to work. The owners who genuinely build wealth this way aren't the ones who found the nicest-looking duplex, they're the ones who understood, before they ever made an offer, that the property's location and its rent-to-price ratio mattered more than its curb appeal. Subscribe, and we'll do this again next week with the next opportunity that costs more than the sticker price ever tells you.